Hello, and welcome. Today we're breaking down the Federal Reserve's latest interest rate cut and why it matters for your wallet. Whether you're saving, borrowing, or just following the news, the Fed's moves shape the economy and your financial future. We'll cover 5 key takeaways from the Fed's meeting and Chair Jerome Powell's press conference. Let's dive in and see what this decision really signals for you and the broader economy. Here's what you need to know. The rate cut itself wasn't a shock. Markets expected it. Investors and analysts had been anticipating this move for weeks, with many already pricing it into their strategies. The real intrigue, however, wasn't about the rate cut itself, but about what would come next. The real insight came from the Fed's summary of economic projections, especially the dot plot. This document is released only a few times a year, and every time it becomes the center of attention for economists, traders, and journalists alike. Each dot represents where a Fed official thinks rates should be in the future, a rare look into their thinking. It's like a window into the minds of the people steering the world's largest economy, showing not just what they're doing now, but what they expect to do months or even years ahead. This time, the dots pointed to 2 more cuts this year. That's a clear sign that the Fed believes the economy will need more help to stay on track, and that they're ready to act if conditions demand it. That's a strong signal. The Fed sees the need for more support. It's not just about reacting to today's numbers, but about preparing for what might come next and giving markets a sense of direction. Looking ahead, the plot hints at another cut in 2026 and one more in 2027. This suggests a long-term plan, not just a quick fix, and shows the Fed's commitment to a steady, measured approach. The message? The Fed is planning a gradual, multi-year path to lower rates. They're not rushing, but they're also not standing still, carefully balancing the risks of moving too fast or too slow. Their goal, reach a neutral rate, about 3%, that neither slows nor overheats the economy. This neutral rate is like a sweet spot where growth can continue without sparking runaway inflation or causing a slowdown. For you, this means borrowing costs could keep falling, making mortgages and loans more affordable. Lower rates can help families buy homes, refinance debt, or invest in their futures with a bit more confidence. For businesses, it's a roadmap for planning investments and hiring. When companies know what to expect from interest rates, they can make smarter decisions about expanding, hiring, or launching new projects. The dot plot offers predictability, but it's not a guarantee. It's a tool for guidance, not a promise set in stone, and everyone knows that circumstances can change. If inflation or jobs data change, so will the Fed's plans. The central bank is always watching the data, ready to adjust its course if the economy takes an unexpected turn. The dots are a snapshot, not a promise. They capture the Fed's best guess at a moment in time, but those guesses can shift as new information comes in. Every new economic report could shift the outlook. A surprise in inflation, jobs, or global events can quickly change the Fed's path. That's why Wall Street watches each update so closely. Investors know that even a small change in the dot plot can ripple through markets worldwide. The takeaway, the rate cut is just the start. What matters most is the path the Fed lays out for the future and how closely reality matches those expectations. The dot plot reveals a longer-term plan for easing, but also signals the Fed's concern about economic risks. It's a reminder that the future is uncertain and the Fed is preparing for a range of possible outcomes. It's both a guide and a warning. The Fed is offering a map, but also flashing caution lights about the road ahead. For now, expect a cautious but steady move toward lower rates, unless the data says otherwise. The journey will be gradual, and the destination could change if the economic weather shifts. The Fed is trying to provide clarity, but the future remains data-dependent. Every decision is shaped by what happens in the real world, not just by forecasts. So, if you're making big financial decisions, keep an eye on these signals. The dot plot can help you anticipate changes, but it's just one piece of the puzzle. The Fed's path could shift quickly. Staying informed and flexible is key in a world where economic conditions can change overnight. In short, the dot plot is the main course, showing a plan for more cuts but also hinting at underlying worries. It's a tool for understanding the Fed's mindset, but not a crystal ball. That's the first big takeaway. The dot plot is essential for anyone trying to read the Fed's next move. Let's see how the markets responded. The next chapter will break down the immediate reaction and what it means for your portfolio. On to the next scene. Wall Street's reaction? It's a mixed bag. Not as simple as you'd think. The market's response was anything but straightforward. The Dow Jones rose after the announcement. Big companies liked the prospect of cheaper borrowing. This was a positive sign for many large corporations who saw an opportunity to expand and invest more. But the S&P 500 and tech-heavy Nasdaq fell, signaling deeper worries. Investors in these sectors were more cautious, concerned about the broader economic implications. Why? Investors saw the rate cut as a sign the Fed is worried about a slowdown. This move was interpreted as a preemptive strike against potential economic troubles. For tech and growth stocks, a weaker economy means less spending and investment. Companies in these sectors rely heavily on consumer confidence and spending. The bond market told its own story. Short-term yields dropped, reflecting expectations for more cuts. This indicated that investors were bracing for a series of rate reductions, but long-term yields rose, a sign investors fear inflation could return without real growth, a scenario called stagflation. This is a troubling prospect, as it suggests a stagnant economy with rising prices. This split reaction shows markets aren't convinced the Fed can engineer a soft landing. The uncertainty is palpable, with different sectors reacting in varied ways. Some see the cut as helpful, others see it as a warning. The divide in opinion is stark, reflecting the broader uncertainty in the market. The Fed's message isn't landing the same way everywhere. Different regions and markets are interpreting the move in their own unique ways. For Powell and the Fed, these mixed signals are a real-time report card. They are closely monitoring the market's reaction to gauge the effectiveness of their policies. The market's anxiety is clear. Rate cuts alone may not fix deeper problems. There are underlying issues that a simple rate cut cannot address. So, takeaway 2. The market's response was fractured, revealing real doubts about the economic outlook and the Fed's strategy. This reaction underscores the complexity of the current economic landscape. The divergence between the Dow and Nasdaq and the bond market's warning highlight the uncertainty ahead. Investors are left to navigate a complex and uncertain environment. Investors are watching for signs of either recovery or trouble. The next few months will be critical in determining the direction of the market. The Fed's next moves will be under a microscope. Every decision will be scrutinized for its potential impact on the economy. The market's verdict: cautious, not convinced. There is a sense of hesitation and uncertainty that permeates the market. That's the second key insight. The market's reaction is a reflection of broader economic concerns. Now let's look at how Powell explained the decision. His words will be crucial in understanding the Fed's strategy. On to the next scene. Stay tuned. At the press conference, Chair Powell described the move as a risk management cut. In other words, the Federal Reserve is taking action now, not because a recession is already here, but to guard against potential trouble that could arise down the road. This is a preemptive step, a way to manage risks before they become crises. Translation: Powell and the Fed are trying to get ahead of possible economic headwinds, hoping to prevent a downturn rather than respond to one after it's already begun. The message: the central bank is watching the data closely and wants to be proactive, not reactive. Powell aimed to project confidence, framing this as a form of insurance, not a sign of panic or fear. He wanted markets and the public to see the Fed as calm and in control, acting out of prudence rather than desperation. But despite his efforts, Powell's message came across as mixed and even a bit ambiguous. On one hand, the Fed's dot plot suggested a path of steady rate cuts ahead, hinting at a clear direction. But at the same time, Powell emphasized that nothing is set in stone and the future remains uncertain. The Fed will be data-dependent, ready to change course if the numbers shift. Every new jobs report, inflation reading, or global event could alter their plans. This approach created confusion. Is the Fed truly committed to more cuts, or is it simply hedging its bets and waiting to see what happens next? Investors and analysts were left parsing every word for clues. Some investors felt reassured by the Fed's proactive stance, interpreting it as a sign that the central bank is willing to act early to support the economy. Others, however, heard uncertainty in Powell's words and grew nervous, worried that the Fed might not have a clear plan or that risks are greater than they appear. Powell's balancing act, trying to be decisive now but flexible for the future, left markets guessing about the Fed's true intentions. It's a delicate dance between providing guidance and keeping options open. Is the Fed steering confidently through the fog or just reacting to every new headline? The distinction matters for how markets and the public interpret the Fed's moves. The answer depends on which part of Powell's message you choose to believe. Some see a steady hand, others see hesitation. The result? More uncertainty, not less. Instead of clarifying the outlook, the Fed's communication left many with more questions than answers. So, takeaway 3, Powell's risk management framing was meant to reassure, but his hedging and careful language injected a new layer of ambiguity into the market's expectations. The Fed wants to be seen as prudent and responsible, but the path forward is anything but clear. The road ahead is blurry, and the destination uncertain. Investors are left to interpret a foggy outlook, searching for clarity in a landscape filled with mixed signals and shifting data. The Fed's communication challenge is real, and the stakes are high. Every word, every signal, can move markets and shape economic expectations. That's the third key point. The Fed's attempt at risk management has, ironically, added to the uncertainty. Next, let's talk about the political backdrop and a new face at the Fed. This meeting had extra drama. It was the first for new Fed Governor Stephen Moran. New members can shift the balance of opinions, but Moran's arrival came amid intense political pressure. The Fed is supposed to be independent, but rate cuts in an election year always raise eyebrows. Powell faced questions about political influence. He responded forcefully. The Fed's decisions are driven by data, not politics. Powell emphasized that inside the boardroom, arguments must be won with evidence, not party loyalty. This was a clear message to markets and the public. The Fed's credibility depends on its independence. Any hint of political motivation could undermine trust and fuel market volatility. Moran's presence highlighted these concerns, but Powell used the moment to reinforce the Fed's core values. The Fed's power comes from its reputation for impartiality. If that's lost, its ability to manage the economy is at risk. So, takeaway 4, the political shadow was real, but Powell doubled down on the Fed's independence. The arrival of a new governor was a reminder of the pressures but also of the institution's commitment to data-driven policy. The Fed's firewall against politics remains strong, for now. Let's look at the final and perhaps most revealing takeaway: internal disagreement. 17. The final takeaway? The Fed is far from united. The vote on the rate cut wasn't unanimous. New Governor Moran dissented, wanting an even bigger cut. That's a strong signal. Some inside the Fed think the economy needs much more stimulus. The dot plot showed wide disagreement, with officials split on how many more cuts are needed. Some want to pause, others want to accelerate. This division is a big deal. Every new jobs or inflation report could deepen the split. Powell's challenge is to keep the committee together and maintain market confidence. A divided Fed risks appearing indecisive, fueling more uncertainty. Moran's vocal stance suggests a more active debate ahead, possibly pulling the Fed toward more aggressive action. The takeaway: the Fed's path forward is anything but smooth. Internal disagreement means future decisions will be contentious and closely watched. For markets and the public, this means more volatility and less predictability. The Fed's internal debate is now front and center. That's the fifth and final key insight. To recap, the Fed's rate cut is just the start. The dot plot points to more cuts, but markets are anxious and the Fed itself is divided. Powell's risk management message was meant to reassure, but uncertainty remains. Political pressures are real, but the Fed insists it's guided by data. The story is far from over. Future decisions will shape your finances and the economy. Thanks for watching. Stay tuned for more updates and let us know your thoughts in the comments.